Defensive Jupiter Merian deal shows fund groups are not safe from M&A. Jupiter and Merian's defensive matchup shows few listed asset managers are safe from becoming a takeover target as the industry grapples with falling assets and enormous pressure from low-cost passive giants.Jupiter stunned the market when it announced on Monday it had agreed to buy Merian. And the M&A news kept on coming as Franklin Templeton confirmed it was buying fellow American rival Legg Mason for $4.5 billion, £3.5 billion. A day later. It is no secret that fund groups have seen stiffer competition from passive products. Merian has lost nearly a third of the £31 billion assets it had when the business was spun out in June 2018, while Jupiter's assets tumbled from £48.3 billion in 2018 to £45 billion toward the end of last year. Investment Association data shows tracker funds attracted a record £18.1 billion from retail investors in 2019. Besting the £15 billion brought in by active funds that year.All asset management groups will be considering M&A. I would hazard that nearly all asset management companies are looking at M&A as a way to deal with fee pressure, says 7M senior portfolio manager Peter Sleep. The rise of passive and the pronounced outflows from active managers has added urgency to this. Jupiter Merian and Franklin Legg Mason are the latest in a string of M&A activity in the funds industry. Last year saw Liontrust acquire Neptune and Premier finalise its merger with Miton. Before that, Aberdeen Asset Management joined with Standard Life to create a £670 billion behemoth. I suspect it's down to basics, CWC Research Director Clive says of the Jupiter Merian tie-up. Both are pretty small businesses. Just compare with £1.1 trillion at LGIM and $4.5 trillion at Blackrock. I suspect there will be a wave of takeovers and mergers as investment management becomes commoditized and scale becomes critical, Waller says. Smaller listed groups are attractive targets. Premier, Miton and Liontrust could all make very nice targets for a much larger asset manager like Schroders once their current mergers have bedded down, as could Polar Capital, says Fairview investing consultant Ben Yeasley. All these smaller groups are quite attractive in that sense, and the likes of Schroders, for example, have the cash to do it. Probably not a UK one, he qualifies. There's no logical fit there. But then again, was Jupiter Merian a logical fit? GAM, which has struggled to rebuild its tarnished brand after the dismissal of star manager Tim Horyud, has also previously been singled out as a target. Meanwhile, there are several predators lurking about. Deutsche Bank's retail business DWS has said it is actively looking for businesses to snap up. Before Jupiter snatched up Merian, rumors were circulating that it was itself the takeover target of the much bigger US manager AllianceBernstein. Yeasley is hoping that one good thing to. For more on this story, visit the news article link.